introduce themselves, give your name, a little background, and your expertise.
Well, hi, I'm Max Gillman. I'm a professor at the University of Missouri, St. Louis. I'm endowed chair of the Friedrich A. Hayek Chair in Economic History. I've always, throughout my career, done monetary economics, what we call it, and in particular, inflation theory. In research, we have to do these general equilibrium models that are representative of the economy and how inflation affects things. For example, my specialty could be said to be that I have shown how inflation lowers economic growth in the long term and have published many papers on that. So I work on inflation. I have a new book called The Specter of Price Inflation by Columbia University Press in the United States and by Agenda Publishing in the United Kingdom. And I go through the history of monetary policy and the intermingling of monetary policy and banking policy by the central bank.
Yeah, that's what I wanted to talk about. And yeah, I think this is maybe one of the more controversial topics, honestly, that I've had here, at least from my perspective, because I get my information on macroeconomics and banking policy mostly from political debates and political discussion. And so, of course, that's polluted by political bias, especially during economic crisis or bank collapse like this. Everyone's pointing fingers in different directions. They say it's the bank's fault, they were overregulated or they were underregulated, or it's government spending too much, or we need to spend more to resolve this crisis. And it's just like, I have my own biases, of course, but it's mostly, at least as I understand my own bias, it's more based on what I think is fair in society and who I trust. So rather than some sort of like understanding of how macroeconomics really work. So that's what I want from this discussion, is to basically understand how money works, where the levers of power are pulling and funneling money to in order to resolve some of these crises.
Well, that's a perfectly proper perspective. When I teach students at the master's PhD level, when I was in Europe before coming back to St. Louis, and I've taught monetary economics for a long time, and students have the best view really before they start learning all this, because everybody has a common understanding of what's going on, some more informed, some less informed, but they all have a basic underlying intuition of what's going on. And your comments just now reflect that understanding. And you're right, people want to know what's fair, what's a good system, what kind of taxes should they be paying? Inflation is a tax. Should they have to face high inflation? And how should banking crisis be dealt with in a fair way? These are all the real questions that we need to answer, both as economists and as people.
So let's just start as basic as I can think of and just talk about what money is and its role in society. I know that even just what money is isn't a simple question, right? Like, I've heard hardcore cynics that just say it's fake, we made it up. And then all the way down the spectrum, people, well, it's kind of made up, but as long as we believe it, it's real. And then other people say like, well, it used to be real when it was tied to gold, and now it's fake, and that's why we're having all these problems. And I don't know, it's kind of ridiculous, all the perspectives.
But that's right. And people do wonder about the gold standard and when the US dollar was tied to gold. That's why in my book, I start with that. I go through the gold standard. And when you have a metallic standard, they call it specie, so that the money is convertible into gold, then there are limits on how much money you can print, because at any time you're going to be able to turn this into gold. Yet people come to the government, they say, okay, I want gold for my money. The limit on the ability to print money is that you have only a limited amount of gold stock. So you have to keep the money supply in, relation to your gold stock. The amount of gold that you hold limits the amount of money that you can print. Well, so what happened with the gold standard is that the US was on it when they were created as a nation, and the first Currency Act was in 1792, and it stipulated the amount of gold and silver as a bimetallic standard that we were on and other nations were on historically. It's in the Constitution as well that we can have money that's convertible into silver and gold. But then the Currency Act set the ratio of gold to silver that each US dollar was convertible into. So then what happened in the Civil War is that we suspended the gold standard. So let me just backtrack 1 second, Matt, to tell you a little bit of history of the United States. When we had the Continental Congress and we started the Revolutionary War, the Treasury printed money called Continentals, and there was a hyperinflation, and that currency collapsed. And as the Revolutionary War was ending, the Continental Congress realized they need to create a new form of government that could raise revenue at the federal level. And so they created the US Constitution out of the Second Continental Congress Convention, which established a federal government that could raise taxes. It also enabled it to issue money, which was convertible into silver and gold. So after that time, the US has never defaulted on its money supply. So the current US government took its form as a result directly of the hyperinflation that occurred during the Revolutionary War, when they had no tax revenue to finance expenditure. So they had to come up with a federal state system, and that's what they did. So then comes the Civil War in the 1860s, and they suspended convertibility because they couldn't borrow enough money from other countries. They needed more revenue to pay for the Civil War. Now, the Confederate States also had their own currency, which had a high inflation rate, but that became worthless after the end of the Civil War. The Northern currency, they were called the greenbacks. And this was the beginning of our current US dollars. And they suspended convertibility during the 1860 to 1865. And then after the war, they did not want to default on their debt. They did not want to have the greenback become worthless. So they lowered the rate of growth of money supply. They issued less money and slowly brought the dollars per gold down to the pre-war parity level. And then they had the Resumption Act of 1875, which enabled the payment of gold, $4 once again, to take effect in 1879. And so from 1879 onwards, we had a gold-only standard. They eliminated silver in 1879. So we had this long deflation, not an inflation, but a deflation from 1865 all through 1879 and on to 1996, because gold was in short supply, because all the countries went onto a gold standard more or less at the same time, and gold became scarce. So the amount of money became scarce. But the US debts were still good because the currency wasn't devalued. So what they paid back remained as it was before the war. So they honored their debts by not devaluing the currency and by establishing the pre-war parity of dollars per gold. So they had this long deflationary experience. And the problem with deflations is that it causes like farmers who borrow money. Actually, when there's deflation, they're getting less for their crops, and they're paying back essentially a higher interest rate when the price level falls. So inflation and deflation redistributes between borrowers and lenders. And the borrowers suffer during a deflation, the lenders suffer during an inflation. When the farmers go bankrupt, banks can go bankrupt. And there were a series of bank panics all through the 1860s. There was a major one in 1906. And finally, the US, which did not have a central bank, decided to create a commission that would study how to create a central bank that would stop the incessant bank panics that kept arising. It was called the Aldrich Commission, and it ended up with a report that recommended the establishment of the central bank. The Federal Reserve Act of 1913 was then passed with the idea that the Federal Reserve would enable bank panics to not occur. In other words, a central bank would somehow pool reserves and lend out to banks when there was a time of panic. That was the idea. That was what the Bank of England did during the 1870s and onwards. A famous book called Lombard Street by Walter Bagehot talks about how central banks collect reserves from all the private banks, pull them together, and then lend them out in times of bank panics to banks so that they stop the panic. And the Federal Reserve was designed with that in mind. And so the Fed was enacted, and in 1914, World War I came about, and they printed a lot of money again during World War I and World War II. But the Great Depression hit, the stock market crash of 1929, and the Fed did not bail out the banks. There was a bank called the Bank of the United States that was in New York. It was first a federally chartered bank that Hamilton had promoted to have like a national central bank. But after a while, that didn't work, and it just became a state chartered bank. So it was just a private bank. But because of its name, the Bank of the United States, in its previous history of having been a federally chartered bank at one time, when that crashed, the bank panic ran across the United States, and the Fed did not intervene because they didn't have the reserves to bail out all these banks. So even though they were designed to stop bank panics, what they were doing, since they were on a gold standard, was simply holding the amount of gold necessary to back up the currency. They had no extra reserves, so they didn't bail out the banks. They had no bank insurance policy. So how did the Great Depression then end? The Banking Act of 1933 was enacted in March, and it ended the Great Depression. FDR was inaugurated only in March 4th of 1933. He did not want to do anything for the banks. And the Federal Reserve was concerned about this. So on March 3rd, the day before he was inaugurated, the Federal Reserve closed down all 12 Federal Reserve banks. They argued that, well, their gold reserves was 24% of the money supply, and it was supposed to be 40%. So they were going to close down the banks. Well, it had been below 40% for a long time. But what the Fed wanted was to restructure the bank system somehow. So FDR was forced to call a bank holiday once he was inaugurated, March 4th. That lasted for 11 days. And during this bank holiday, they closed down the entire private banking system. At the end of the 11 days, they reopened the banks. They classified them into A, B, and C. The C banks were closed down. The A and B were reopened, and they were given federal deposit insurance under the, at the time, temporary Federal Deposit Insurance Corporation, which became permanent in 1935 and exists to this day, where the deposits that you have in the bank up to a certain amount are federally insured. And FDR's fireside chat, his very first one, was about the new bank insurance that was being offered by the FDIC in the Banking Act of 1933. And he said, put your money back in the banks. You can trust the banks. They are now insured. And so people massively, they'd been taking their money out of the banks in a bank panic run. And when you take the money out of the banks and they don't have the reserves, they call in their loans and they still don't have enough reserves. And so they go bankrupt. So then people put all their money back in the banks at the end of the banking panic after FDR's fireside chat and after federal deposit insurance was started. People trusted the system, and the Great Depression is dated to have ended in March 1933 when the FDIC was created. That's the history that leads up to today. And the amount of insurance of the banking system that's going on, it's become convoluted between the FDIC and the Federal Reserve, each playing a different role in it today, which I can discuss.
So it sounds like what the dollar represented in the economy has changed a lot throughout time, right? It was for some amount of gold and some amount of gold and silver. So that would be that it's tied to a physical thing, a commodity, whereas the continentals that you talked about at the beginning, that's basically just creating debt. That's money as just a promise, basically then. So those are two different ways, I guess, of conceiving of money, right?
That's right. And the Continentals did not even include the promise to pay. In the Civil War, when they printed the greenbacks, they included on the notes promise to pay. They just weren't going to do it right away. So when you have a money that's not backed by gold, it's called a fiat currency, meaning it's by dictate a legal currency, but it's not worth anything. It can't be redeemed into a specie. So the Continentals were irredeemable, but the greenbacks were redeemable eventually, not immediately, into gold and silver. And so that metallic standard existed all the way up until 1971. It changed in nature and it evolved over time, the money, whether or not it was convertible into specie. In 1944, as World War II was progressing and potentially nearing an end, they had a conference in Bretton Woods in the United States that created the United Nations, the International Monetary Fund, and the World Bank, as well as a new gold standard. It included 29 other nations. And the nations were linked with fixed exchange rates to the US dollar, and the dollar was linked to gold at $35 an ounce. That was the current market price at the time. And that regime existed up until the Vietnam War. And during the Vietnam War, just like in the Continental Congress and the Revolutionary War and in the Civil War, the United States printed money at a faster rate to finance government spending. So they were still on the gold standard. And that meant that any country that had US dollars could take those dollars and give them to the US Treasury and get gold for them. So the Bretton Woods standards evolved from giving people the right to convert to gold to only allowing central banks the right to convert to gold. This happened in the 1960s once the increase in the US dollars made the price of gold rise above $35 an ounce in the free market. So they had to stop allowing private individuals to convert US dollars into gold. And then they said only central banks could do it. Now, if central banks had started doing it, the US would have had to lose their gold and the gold standard would have ended. And the central banks didn't want the Bretton Woods gold standard to end. So they absorbed the US dollars that were printed to finance the Vietnam War. How did they do this? Well, take France, they would print French francs and buy the US dollars, hold the US dollars, but then they would have more French francs in circulation. So the French inflation rate went up as the US inflation rate went up in the 60s and 70s, as the UK inflation rate went up, as the Japanese and all the countries in the Bretton Woods system imported the US inflation rate in order to keep the fixed exchange rates and the convertibility of $35 per ounce of gold. So how did this happen? Well, the Federal Reserve bought Treasury debt, and the Treasury was having to have bigger deficits because of the Vietnam War. So they would borrow more because of the Vietnam War. And the Fed was buying a greater portion of this treasury debt during the Vietnam War. Now, when the central bank buys the treasury debt, that's like giving freshly printed money to the government to spend to cover their spending. This puts more money in circulation, raises the inflation rate. So it's like an inflation tax. The money that the central bank buys in terms of treasury debt is the way the treasury collects the tax. When they use freshly printed money and buy goods for it, they're already collecting the value of the tax revenue. Then people don't feel it until the inflation rate goes up. Then they feel the inflation tax. So the treasury collects it as soon as it spends freshly printed money on goods and services. The people only feel the inflation tax once the inflation rate rises. Now note, there is one complication. The Federal Reserve is only allowed to buy a tiny bit of treasury debt directly, essentially zero now. So they have to go through the private banks. The private banks buy the treasury debt, and then the Fed buys from the private banks. Milton Friedman called this going through the middleman. It's like the Federal Reserve buying treasury debt, but they have to go through the middleman of the private bankers who earn a commission on this transaction, but it's still printing money. What happened is that with the inflation rate rising all through the Vietnam War, France finally said in August of 1971, enough. And they decided to start cashing in their US dollars for gold. President Nixon immediately closed the gold window, where the Treasury would no longer redeem US dollars for gold. It was only to central banks, but France was trying to cash in, and the Bretton Woods gold standard stopped from that day forward. We were no longer on a gold standard, and all the other countries also then were off the gold standard. And therefore, all the currencies from August 1971 forward have been fiat currencies, not backed by any metallic standard.
Mhm. Right. So what I heard, and you can explain this to me, is that once you have this fiat currency, then the only way it has value is because you have to use it to pay your taxes. Basically, you can't pay your taxes in other governments' money. You can't barter with them. You have to pay them in dollars, in US dollars. You have to pay the US government in US dollars. So you need to get some, and that creates a demand for the dollar. And currently we have to do commercial transactions with dollars as well. We don't really have a good bartering system, and corporations need to use dollars and report their income in dollars and all these things too. So is that basically what creates the value then, or the demand for a fiat currency?
Matt, these are very good questions. And the legal tender stated on the US dollar means that it can be used to pay obligations of the government, in other words, taxes. So the legal tender right of Federal Reserve notes is what gives them the value that makes them the US currency. So yes, what you said about the fact that they can be used to pay taxes is the basis of a government's currency. That's exactly right. Now, what is the value? The value comes not just because you're paying taxes. The value of the dollar is how much goods and services you can buy with it. So if the dollar depreciates in value, you can buy less goods, and if it appreciates in dollars, you can buy more goods and services. Just think if there was a deflation, the price level would be going down. If you had a dollar and the price level went down, you could buy more goods and services with each dollar. So during a deflation, your dollar appreciates in value because it can buy more goods and services. Now you can understand easily the reverse. When there's an inflation, your $10, what it could buy before the inflation and what it could buy after a year of inflation is less. The value of the dollar depreciates because those $10 buy less goods and services because the price level has gone up. So the fundamental value of any currency is how much goods and services it can buy. The legal basis for a government currency is the legal tender ability to pay taxes with it. So you're getting at the bigger question of what is the money supply and how does that determine the value of the money supply? You brought up corporations and you mentioned accurately how there's money in many different forms across our income accounts and our bank accounts. So is this money that we have in the economy only the fiat currency, only the US dollars? The answer is no, it's not. So there are two types of money, public bank money and private bank money. And both monies are used to buy goods and services. The public money is the Federal Reserve money, the currency. The private bank money, well, how does that get created? Let's say a bank gives you a loan for a car for $10,000 or for your business for $100,000. They will give you in your account this $10,000 or $100,000 that you can then spend. So they create, we call them demand deposits traditionally, because you can immediately demand that money back from the bank. That's what happened to SVB. People had demand deposits. They could demand them on a moment's notice. Okay, I want that money back. And of course, that money is ultimately US dollars. So banks create these demand deposits, which are money that you can spend. This is the private bank money. So when we define the money supply, for example, in economics, when we want to study how the money affects the economy, we have different definitions. One is for the public bank money, how much money the Federal Reserve prints. The other is a broader aggregate, which include both the currency in circulation, the Federal Reserve notes, and the demand deposits. And together they determine the inflation rate. Now, the difference, though, between the public and the private is as follows. The public bank money has no limit. The Federal Reserve can just can finance Treasury expenditure by buying Treasury debt through the middleman of the bankers as much as it wants. And during the COVID crisis, they greatly increased the amount of Treasury debt that they bought. After 2008, during that financial crisis, they greatly increased the amount of Treasury debt that they bought, just like during the Vietnam War, the Civil War of the 1860s, and the Revolutionary War. But private banks, on the other hand, don't have the ability to just make unlimited amounts of loans because they know they have to allow depositors to take out that money at any time that they want. So they have to keep reserves on hand that are sufficient to cover the expected deposit withdrawal. What happens in the private bank money is a cyclical up and down. During expansions, the loans go up and the private bank money supply goes up. During a contraction, recession, bank loans go down and the private bank money goes down. The Federal Reserve, on the other hand, what they do essentially is they keep the money supply growing at a stable rate in line with the economy's growth rate, except during crises. Then they finance the big government expenditure increase by buying more Treasury debt, creating more money supply, which can ultimately cause greater inflation.
Right. So they're trying to keep the total money supply more or less the same because you don't want these dramatic swings in the money supply because it changes the value of the money and causes inflation or deflation. I guess we've seen the big bank failure with Silicon Valley Bank and what was the other one? The Signature Bank. So that money just disappeared.
Well, that was money that was insured by the FDIC. So they had bank accounts and they were insured by the FDIC up to $250,000. That's the current dollar limit. And then after that, the FDIC doesn't insure more. Now, how does the FDIC work? It charges like a car insurance system. They charge a premium per dollar of deposits that are insured. So banks pay to the FDIC an insurance premium, and then the FDIC collects this in a reserve fund. And during a crisis, if a bank goes bankrupt like SVB did and its subsidiary Signature Bank, then the FDIC has to guarantee those depositors up to $250,000, and they use their reserves to do that. The FDIC, they claim they've never lost a single dollar of deposits. They've always had all depositors paid out during bank crises. So what does the FDIC do when a bank fails? If they become insolvent and they close down the bank, well, the FDIC will take the assets of that bank and sweeten the merger by using the reserves they've built up. First, they insure the depositors, they pay out all the depositor accounts, and they also add in extra money so that another bank will absorb the failed bank. So they merge the bank with another bank, and the bank takes over all the deposits, they're all insured, and so no losses to insured accounts have ever occurred. That's how the FDIC has worked since 1933 to this day. The only difference in the FDIC is that they began charging risk-based premiums in 2006. In other words, think of your car insurance. If you've had a lot of crashes, then your insurance company is going to charge you a higher insurance premium. So the FDIC started charging risk-based premiums in 2006, where banks with a riskier asset portfolio would get charged a higher rate of insurance per dollars of deposit that was insured. And that's a good system. The problem is that the FDIC only limits it. Now, I've proposed in my book that the FDIC could allow unlimited insurance of deposits, just charging a higher insurance rate, say from 250 to 350, a higher insurance rate, just like in your car insurance. If you get a lower deductible, and so you have more dollars insured, you pay a higher premium. So the FDIC could charge a risk-based premium on the first 250, then a higher rate on the next tranche, a higher rate on the, but they don't do that. So what happened at SVB is people had these accounts that were way above 250,000. And so they saw that there was a problem. So they tried to get their money out, all of it. And SVB did not have, well, this is what SVB was doing. Usually SVB would have been able to have a proper amount of reserves, but there's a simple reason why they didn't. What would be a proper amount of reserves? Well, if they had had short-term treasury debt, which is what the financial system uses globally, US Treasury short-term debt, like 3-month security. So they pay an interest rate only over 3 months. And that's the current gold of the global financial system. The most liquid asset in the world is short-term treasury debt. So banks would usually hold a lot of short-term treasury debt so that if there was a depositor run, they would simply cash in their treasury debt and they wouldn't make any loss because the interest rate, if it's only 3 months, their interest rate, even if it's moved a little bit over the 3 months, it's not going to have moved much. So you don't have any capital loss or gain when you sell your treasury debt when it's such a short-term rate. They cash it in, they pay off their depositors. The problem is that it's a complicated one, but the problem is that since the terrorist attacks in 2001, the United States government and the Federal Reserve have been forcing interest rates on short-term treasury debt below the normal rate that includes the inflation rate. So if the interest rate equals the inflation rate, the real return is zero. If the interest rate is forced below the inflation rate, which it's not, in previous history, it's almost never been below the inflation rate since the 1970s, the Vietnam War. But for 20 of the last 23 years, the Federal Reserve has forced interest rates below the inflation rate, while at the same time, they bought a huge amount of Treasury debt and increased the money supply. So what happened is that banks, what do they do for their customers? They invest their funds in a portfolio. They have to diversify it between a relatively risk-free asset and the risky asset to get a safe market return. What's the risk-free asset? Short-term Treasury debt. It's the safest risk-free asset in the world. What's the risky asset? The market portfolio. In other words, they buy stocks, they buy private market companies, and they get a higher return on that, but it's riskier because private companies can go bankrupt. So this is what all investment banks do for their customers. They diversify between risky and riskless government debt and give them a balanced market return that's relatively safe. But this got spoiled when the return on short-term Treasury debt became negative for 20 out of the last 23 years. So what do the portfolio managers have to do then? If they want to have the same return, they have to hold less of the risk-free Treasury debt and have more in the equity. And not only that, they have to go for riskier assets in the equity portfolio because riskier assets have a higher yield. In other words, in finance, there's higher risk going along with higher yield, lower risk with lower yield. So to get a higher yield on your equity, you go into riskier, like internet stocks like Microsoft, Apple, Netflix, into the riskier portfolio. You have a greater share of that, and you have less of the riskless Treasury debt. But the other thing you can do is try to find the next best riskless asset. This is what banks did after the 2001 terrorist attacks. When the interest rate was driven below the inflation rate for 3 years, from 2002 to 2004, by Alan Greenspan, who was the governor of the Federal Reserve System, the private investment banks just vastly went into mortgage-backed securities. What are those? Savings and loans give you loans for your house, and those are called mortgages. Then they began packaging them together and selling them to investment banks. So investment banks would buy this package called a mortgage-backed security of mortgages. They would get the loan payments that people make on the mortgages. That's what they would get after they bought that. So investment banks would buy, well, what they did after 2001 is they massively increased their investment in mortgage-backed securities because those were viewed as totally safe because housing prices had been going up nonstop for so long. But then, just like what happened in 2021, what happened in 2004 is the Fed decided to suddenly increase the interest rate very quickly to get it back above the inflation rate, which was rising because of the increase in the money supply that drove down the interest rates. So they quickly increased the interest rate. It was 1% in 2004 and 5, and they raised it by 4.25% up to 5.25 in 2007. So very quickly, they raised the interest rate. And what happened? A lot of people had variable rate mortgage loans. In other words, if the short-term Treasury rate went up, their interest rate would go up. And the amount that they would have to pay each month on their mortgage would go up. I had a variable rate mortgage. If you have a 1% increase in the interest rate, it's a big increase in your loan. If you have a 4.25% interest rate increase, which is what happened from 2004 to 2007, you can't pay your loan back.
That's
So
projected
that's,
over such a long time.
yeah. And that's why all of the people, so many people went, underwater. Their mortgages, they declared personal bankruptcy. Their mortgages went into default. And guess who was holding the vast amount of the mortgage-backed securities as the safe asset to get away from holding short-term treasuries that were yielding a negative real rate of return? The investment banks.
Mhm.
So the investment banks were holding the hot potato. They didn't anticipate the Fed suddenly raising interest rates and making these safe assets unsafe. So the banks really didn't do anything wrong. It's not like the banks were being irrational, were doing, taking unnecessary risks. They were being rational. They were going to the next best safe security, mortgage-backed securities. They had no idea the Fed would do what they did. So the Fed essentially induced the collapse of the mortgage loans and the collapse of the investment banks that occurred in 2008. Now, the fun part is that the investment banks were totally uninsured by the FDIC, as opposed to commercial real estate banks. This is a small complication, but it is informative, Matt, for everything that's going on today. What happened during the Vietnam War is that there was an interest rate ceiling of 5.3% that was put in the 1933 Banking Act that created the FDIC. This interest ceiling was during the gold standard when they figured, well, you can't have fiat inflation, so the interest rates are never going to go very high, maybe 2%, 3%. So if a bank is charging more than 5.3%, that would be usurious. So they didn't think this was unrealistic during a gold standard period to have a 5.3 interest rate ceiling. They just said, let's stop, usurious activity, too high of interest rates being charged by banks. They didn't envision the end of Bretton Woods, the end of the gold standard, and a fiat money inflation occurring. But that's what happened. In the 1970s, the inflation rate went from 1 to 2, 0 to 1 to 2%, up above 5%, up above 7%. It went up to 12%. So, I was telling you that banks want to pay an interest rate that at least covers the inflation rate, but they were restricted. They couldn't pay more than 5.3% on their deposit accounts. They couldn't pay a higher interest rate. So the inflation rate went above that, and depositors were getting a negative return on holding savings accounts at banks. So this is what happened. Non-bank banks came into being, which were the investment banks offering money market funds and mutual funds, is the other name for it, that were not FDIC insured, but were exactly like the deposit accounts at a commercial retail bank, but it paid a higher interest rate. They were not restricted by the 5.3% ceiling because they were not part of the Federal Reserve FDIC system, the investment banks. So the investment banks began offering money market accounts. From the late 1970s until 2008, demand deposits at the commercial retail banks were flat. The economy is growing all through this time, so they should have been going up, but they were completely flat. What was growing? Money market. Money market funds were going up dramatically. So what does that mean? The part of the banking system that was insured, the FDIC part, had no growth. The part that was uninsured exploded because they were paying higher interest rates. And What happened then? The investment banks, the money market funds, the mutual funds, there was a run on those in 2008 when the mortgage-backed securities went into default. People got worried and started taking their money market funds, mutual funds out of the investment banks. They were exactly the same as demand deposits at a commercial bank, but they were not FDIC insured. And just like commercial banks during a panic may not have enough reserves, the investment banks did not have enough reserves. Lehman Brothers was the first to collapse, and the Fed did not bail them out, did not stop the bank panic, so it spread to other investment banks. So what does the Federal Reserve System do at this point? These are uninsured deposits completely. They have no insurance, and people had long argued that the investment banks did not need to be regulated, did not need to be brought into the FDIC, that they could never go bankrupt. So during the 1980s, up until 1994, and really it continued up until 2006, we had a series of financial deregulatory acts that allowed the investment banks to have these money market accounts, and it made them legal. And it made everything the investment banks were doing legal. It allowed them to branch across states, where interstate branching was actually prohibited by the 1933 Act. But banks were getting around it through bank holding companies. They would buy banks in different states and have effectively interstate branching. And so in 1994, that was eliminated. So all the restrictions of the 1933 Act were eliminated. It created a two-tier system. The FDIC insured banks and the non-insured investment banks, pensions, life insurance companies, all of those were bailed out in 2008 because the Federal Reserve had a global financial collapse that it was facing. So it had to decide what to do for the uninsured banks. So it did a very ad hoc after the crisis bailout. This would be like you, Matt, saying, well, I'm going to drive around without car insurance and I'm not going to really worry about it. And oh no, then you have a crash. So then you go to your insurance company and you say, look, I'll pay a premium on my insurance and you cover my car crash. Well, guess what? They don't insure you for a crash that happened when you were not insured. Only if you're insured will they pay. But what the Federal Reserve did, instead of like the FDIC, which is an insurance system that's in place before the crash and pays out after the crash, the Federal Reserve did not have an insurance system in place for the non-insured investment banks and the rest of the financial intermediaries. So they were faced with bailing them out after the crash. And they did that again with SVB. The problem with SVB was a little different. Instead of holding mortgage-backed securities after seeing what happened in 2008, they switched from short-term treasuries to long-term treasuries, 10 years. Now, what does that mean? They lock in an interest rate for 10 years at whatever rate they buy it at. So they're buying, the interest rates were 0.1% during COVID. They were raised to 0.15 of 1% during COVID. And that was it until the Fed started rapidly raising interest rates. So the difference between the short-term treasury debt and the long-term treasury debt in this past 20 years, that the long-term treasury debt covered most of the inflation, was around 2 to 3%, which was covering the average inflation rate. So the long-term treasury debt was yielding close to zero, but at least it wasn't negative. So SVB, instead of substituting from short-term treasury debt to mortgage-backed securities, they substituted from short-term treasury debt to long-term treasury debt that was at least covering the inflation rate. But then the interest rates were rapidly increased again. And it was just like what happened to the mortgage-backed securities. If you try to sell treasury debt that's yielding close to 0% interest rate, when interest rates are now 3%, you're going to suffer a capital loss. Because that treasury debt's only paying out 3%, to sell it at the current market rate of 3%, you have to sell it for less. So when you sell treasury debt, you're always selling it at the current market interest rate. But if you've locked in a low interest rate, and then you sell it at the current market interest rate, which is much higher, you suffer a big capital loss. So SVB sold the treasury debt, which was long-term, and suffered a big capital loss and did not have enough reserves to cover the depositors. The depositors did a run on the bank because they anticipated that SVB would be insolvent, and then SVB became insolvent because only $250,000 worth of the deposits were FDIC insured, and people had put in millions in accounts. Each customer who did that made a bad choice. What people usually do, and there are systems you can buy, companies that do this for you, is if you have $1 million, they put it in 4 different accounts so that at 4 different banks, so that all of the amount is FDIC insured. Up to 250 in 4 different banks would be $1 million. So customers didn't do that at SVB. They put in millions, and only 250,000 was insured by the FDIC.
The point of something like that would be then to spread the risk around a little bit. The point of having that cap on the amount that's insured is because if they want to take all that money out, then that's a big risk to the bank of their assets. And so the government put that rule in basically to protect their insurance and spread that risk out.
So that's a fantastic question of why the FDIC dollar limit is put in place. And the short and simple answer is that it's historical. When the FDIC was created, it was a set amount of dollars that would be insured. And that was meant to be just the reasonable amount that most customers, would be below anyway. And then this was raised over time, essentially in line with inflation. So it became an amount that was no longer above what most customers would have. Why? Because the US economy and the wealth accumulated in the US rose dramatically from 1933 to 2023. We had dramatic wealth accumulation. So the traditional limit on the FDIC insurance, how much they cover per account, is historical, and I have never heard a logic put forth for this in terms of spreading the risk across different banks. That's a sensible way to look at it. I don't think that's how it came about. And I don't think it's necessary to have such a limit. I do think the FDIC could raise it to any amount. See, in economics, we have what we call an upward sloping supply curve, a downward sloping demand curve. And the equilibrium between supply and demand determine the equilibrium price. So think about it in deposit insurance. You're going to supply deposit insurance. Now, you will supply a greater amount. But when you supply more, like let's say a car manufacturer is going to produce more cars and has to have an overtime, it becomes more expensive when you ramp up your production. So the cost goes up. That's why the price will go up as you supply more. That's why the supply curve is upward sloping. It costs more when you produce more on the margin. So the FDIC can do the same thing. There's no rational reason to have a limited amount of only $250,000 per account. They could simply charge a higher risk premium on the next tranche, a higher risk premium above that, just like your private insurance, where when you have a higher deductible, you have to pay a higher insurance premium.
Getting vibes of why people think this is all made up, because it seems like it's just a lot of agreements. and it's not backed by any real thing necessarily. It's just backed by the word of the bank that they're going to control interest rates in some reasonable way. The banks that they're going to take your money and do something reasonable with it. The description of financial crisis basically then is just that promises can't be kept anymore. People made these promises, these agreements based on certain assumptions. The assumptions change. They can't keep these promises anymore, and then things start going kind of crazy.
You're right. That's exactly what happens. That's what causes a bank run. If people lose trust in the ability of the bank to pay out their deposits when they want them, then people will withdraw that money, and that causes a run. That's what's happening now. So the problem is that the Fed decided once again, when inflation took off finally in after the COVID spending, the Fed bought a huge amount of treasury debt, printed a huge amount of money, and it entered circulation. It caused the inflation rate to go way above a near zero interest rate. So the real return on treasury debt became more and more negative as the inflation rate went up. So the Federal Reserve has to try to normalize interest rates by bringing the interest rate back closer to the inflation rate. And a normal interest rate would be to get it above the inflation rate. In 2007, after 2 years, a year and a half of raising the interest rate very rapidly, they finally got the interest rate above the inflation rate. The inflation rate was rising, so they had to keep raising the interest rate. And so for a short period of time, the interest rate rose above the inflation rate, and then mortgage-backed securities collapsed. So this is what's happening today. The Federal Reserve rapidly raised interest rates again to try and get them close to, or hopefully above, the inflation rate. But it was such a rapid rise. So we've gone from essentially 0 to 4.9. In 2007, we had gone from 1 to 5.2. That was a 4.25% increase. Now we have essentially an over 4% increase in the interest rates in a very short period of time again. So people holding these longer term safe assets like long-term treasury debt are going to suffer a financial loss from holding that because interest rates went up, and this weakens banks across the global financial system, which is why Credit Suisse, which was a historically dominant bank in Switzerland, famous bank, had to be absorbed by UBS, the other main Swiss bank. So there have been two major bank collapses, the SVB, which includes Signature, and the Credit Suisse, which now has been absorbed by UBS. The third one that's going on is First Republic. So there's a current additional bank crisis. People have lost confidence in the ability of First Republic to pay out their depositors. This bank does not have all of the deposits insured by the FDIC. So what is the Fed doing? They don't have a pot of reserves like the FDIC. They did induce private banks to hold more reserves at the Fed after 2008 by paying interest on reserves. They accumulated 3 trillion, it went up to 4 trillion after COVID, and they still have 3 trillion in excess reserves being held at the Federal Reserve right now, owned by each private bank. The private banks, when the Federal Reserve bought treasury debt from them, they get reserves credited at the Fed that they can spend, but they didn't spend them. They kept them at the Fed because the Fed started paying interest on reserves. So this sterilized the money supply increase from 2010 to 2014. Then some of the reserves started to get lent out when the interest rate started to rise and the real return on capital became positive. Well, all these reserves are being held at the Fed, but the Fed doesn't own them. The Fed cannot pull them together like the Bank of England in Bagehot's time. The Bank of England in Bagehot's time had all the private banks putting their reserves and holding them at the Bank of England. They pulled them together like the FDIC does and could lend them out during a crisis and stem the bank crisis. First Republic is about to go bankrupt. It's not FDIC insured, so you can't use the FDIC pot of insurance to bail them out. So what do? You can't use the reserves held at the Fed because those reserves are owned by the private banks. The Fed can't pool them and lend them out. So they've accumulated all these reserves, which is decreasing investment and growth in the economy, but not providing bank insurance because the Fed cannot pull them together and lend them out. So what did the Fed do? They went to the largest banks who are holding the vast majority of these excess reserves at the Fed, and they said, look, would you guys please lend First Republic 50 billion? So they got the, I think it's 5 major banks to agree to lend 50 billion out to First Republic to try to avoid a bank run at First Republic, because there is no insurance system in place for the uninsured deposits. That's the vast majority of the system, and that First Republic has a vast majority of now.
I know there's different regulations in different countries for the banks and what they're allowed to invest in and what they're allowed to do with the money from depositors. I guess you talked that they leverage some riskier bets and some low risk bets, and these kind of change over time. But I've also heard that countries just don't allow banks sometimes to make these risky bets. If they're a depositor money, you're just investing in safe things, and that affects the way that these crises happen in these countries.
Matt, that is very well put. I can address that. In a free market, in the capitalist system where you try not to intervene in capital markets, you do have some regulation of banks. So what's a perfect regulation? If you have a tax on your labor income, then you're going to work less because you have to pay taxes. You're going to get less for every hour you work. That's the distortion that taxes cause. That's why governments don't like to raise tax rates, because tax rates discourage, if it's a tax on corporate income, it discourages investment. The higher the taxes, the less the investment. If it's tax on labor income, it discourages labor. The higher the personal income tax, the less you're going to work in the labor force and the amount of time you're going to work. So having low tax rates encourages more work. Regulations work like taxes, typically, where you try to regulate industries. It's like an implicit tax. Now, what does the government really want to do with its regulation? What is the government really doing with all of its spending? It's providing a social insurance network. You could view all government spending, not social insurance in terms of the Social Security trust funds. That's part of the social insurance system, having old age and survivors trust fund and the Medicare trust fund and the disability, the 3 trust funds of the Social Security system. That's part of our Social Security system. That's part of our network of social insurance. But think more broadly, police in the event of crime. When you have the bad state occur, you need police. And when there's no crime, you don't need police. Defense. When there's no military threat, you don't need military. So it's insurance against war. Police is insurance against crime. You could think of all government spending as being optimal, trying to achieve an efficient, optimal social insurance system. Banking insurance, like health insurance, is a key part of a social insurance scheme. So people can view banking insurance as regulation, or they can view it as part of an insurance system. Now, what's the difference? if you take your car insurance example again, in a competitive equilibrium market, the car insurance company is going to take in the expected value of the premiums that are paid in will be equal to the expected value of the payouts they have to make in the event of crashes, plus a return on their capital. That would be a normal insurance system that operates in the private market economy. It's efficient. The competitive market drives efficiency in the private market insurance system. Now, sometimes private markets cannot cover certain insurance events, and that creates a role for the government social insurance system. What's an example? During a recession, you could not create a private insurance system that would cover unemployment insurance. It's just too hard. So the government provides unemployment insurance. In every state of the United States, there's a state unemployment insurance system. Plus, we allow federal supplementary unemployment insurance if Congress authorizes it. So we try to create an efficient unemployment insurance system, but it's not efficient. Why? Because if we pay out benefits on an unending basis, like we used to do before it was reformed under President Clinton, then you're subsidizing people to be unemployed, so they stay unemployed. So this is a problem with a social insurance system if it's not efficient. You create a greater probability of the bad state of affairs occurring. What is that? More unemployment, less human capital accumulation, less growth in the economy. So you want to have efficient regulation as part of your unemployment insurance system, as part of your banking insurance. So how does this come in? The FDIC was an efficient banking insurance system for all the banks that were in the FDIC. However, because the FDIC charged a flat rate on all insured deposits, that gave banks the incentive to take on more risk, knowing that they still had their depositors insured. And this was always called a moral hazard problem, that banks would take on more risk because they knew they were insured at the flat rate. So finally, there was an act of Congress in 2006 that created risk-based premiums in the FDIC. So they would raise the risk if the bank had a riskier portfolio. So this was a way to provide efficient bank insurance, which is, you can call it a regulation, but it's a premium banks are paying in return for insurance. Now, the problem with the United States and across the world is we had uninsured investment bank money market accounts that arose out of the interest rate ceiling of the 1970s, and that remained uninsured by the FDIC. So then we had to do very inefficient bank insurance after the crash. And how did the Federal Reserve deal with this? Well, the United States dealt with this by increasing regulations. That's what they did in the Dodd-Frank Act of 2010. They finally re-regulated the private bank market by requiring greater capital reserves being held by the largest banks. Well, that's a palliative. That doesn't really address the fact that the deposits are uninsured by the FDIC. So we are faced with a system that has an inefficient bank insurance because it's got the FDIC covering one set of deposits in an efficient way, and the larger set of deposits are totally uninsured and covered in an ad hoc, after the fact, inefficient way. So this induces governments to consider greater regulations on banks, trying to, well, increase capital reserves is the number one regulation that they go to. But an alternative would be to bring the non-bank banks, the investment banks, pension funds, the insurance companies into the FDIC, allow the FDIC to offer insurance on a risk-based premium basis for all of these not make it mandatory, but allow the FDIC to bring these in to offer rates. So when that doesn't happen, you have a big problem. Now, governments around the world that are less free market oriented than the United States, go back to your question, worldwide, they can require banks to hold only safe assets. They can require banks not to lend out their money any way they want. But let me just add one other thing. The whole basis of a bank making money is that they do get depositor accounts and they get in these deposits. Now, the deposits could sit there and just be put into short-term treasuries or just not invested at all and be perfectly safe. But then the banks don't make any money. So how does a bank make money? They optimally lend out a certain amount of those deposits and keep a fraction, in reserves. So banks have to decide how much and what degree of risk to take in the loans that they make and in the assets that they buy in order to get a yield on their business.
Right. So they're taking risks, and then there's some consequences to failing to judge that risk appropriately, right? And that's either by paying insurance or I guess just losing their money. And then, so what happens when a bank goes bankrupt?
Well, that's the problem. When a bank goes bankrupt in the 1930s, it created a bank run across the whole financial system and it spread internationally. So there was a collapse of capitalism when the bank system collapsed in the 1930s, and the unemployment rate was 25%. The inflation rate went to a negative 10%. Why? The Federal Reserve Bank money was growing at a very slow, stable rate during the Great Depression, but the private bank money supply collapsed because the loans collapsed, the deposits were withdrawn. So the money supply went down dramatically and the inflation rate was negative 10%. When the FDIC was created in 1933 and people put their money back in the banks, it went from negative 10% to plus 6% in about 1 year. So then it stabilized at a normal rate. The unemployment rate went down and the Great Depression ended. So having a bank collapse go on without any government intervention is risky. So you can certainly just allow the depositors to suffer the consequences and the bank to suffer, people who own the bank stock to incur the loss from owning that. Yes, that is the capitalist system, that you simply, when a firm fails, you simply take the loss. But the problem is when it's the banking system, it can spread and create a panic that spreads to banks that are actually solvent, but people lose trust. You started out with the view that we have to have trust in the money in the banking system. We lose trust in the money when it goes from a high to moderate inflation to hyperinflation. We don't want to hold the money, we stop holding the money. We lose trust in the banking system and the banking money when the banks look to be insolvent. So the government cannot allow unending financial global collapse, because in the 1930s, it threatened the existence of democracy, and it led to the rise of the far left, the communist regime, and the far right, the Nazi regime in the 1930s. The communists, of course, started in 1917, but that was enhanced in the 1930s, and the Nazi regime rose out of the 20s and into the early 30s. That's when the Nazi regime became dominant. So you get the same type of bipolarity existing today. Why? When you repress the interest rate below the inflation rate and you have negative returns on treasury debt, you force this greater financial risk, you have lower growth, you have less investment, and this weakened the financial system internationally and led to nationalist regimes like the Orban regime in Hungary, the Polish regime also became very nationalistic, and democracy became illiberal. So you do not want ongoing financial weakness. You need the treasury, short-term treasury, the new gold of our current financial system, to be used and to be liquid and to have a positive real return, so that you don't have to have greater risk in the other assets that the banks hold. So you need to normalize interest rates so they're above the inflation rate. You need to rein in the money supply growth rate so you don't have a high inflation rate. And you need to come up with an efficient way to ensure banks, rather than an ad hoc, fractured insurance system, I call it in my book, that we have now, with the FDIC insuring part of the system and the rest of it uninsured.
Mhm. Yeah, that makes a lot of sense to me, especially drawing to your earlier analogy with the driver's insurance, where maybe it would be okay not to be insured if it's just you getting into a car crash yourself and you only affect, your health and your vehicle. But the problem is people are crashing into other people and then they have to fund their damages. And if they're not insured, then what happens? Who pays for that? And so I guess what I'm hearing from you is the problem is you got banks running around crashing into other banks and they're not insured, and it's just causing all kinds of problems, right?
That is a great analogy. I never thought of that, of crashing into each other. Perfect analogy.
Okay, cool. All right, I can put that in my head. So that makes a lot of sense to me, and something kind of actionable too. It gives me a little bit of optimism.
Well, I do think that people are thinking about this, but if you look at my plan for expanding the FDIC, I actually asked the vice head of the FDIC this at a conference, and he answered me. I said, "Why don't you expand the FDIC to include investment banks?" And he says, "I can just imagine all the lobbying that they'll do on their rates." And he recommended, Thomas Honig, having greater capital reserve requirements for banks, having greater regulations. He did not want to expand the FDIC. So my ideas are not being adopted by anybody. What people are thinking of is what you said: greater regulations, greater capital reserves. But the thing about Bagehot's England is, the reason why England was the financial center of the world is because when banks, rather than each bank holding a lot of reserves itself, if the banks could pool the reserves at the Bank of England, the total amount of reserves being held was smaller. So more was being invested. If you take Thomas Honig's idea, which is really the main idea around, to increase capital reserve requirements, that means more banks holding more in reserves and lending out less. So you have less investment and less growth. So it's not an optimal solution. I hope that people are thinking of a broader solution in the terms that I have put forth with you today, but I can promise you I am a isolated, tiny voice.
Sure, I'm sure there's a lot of interest here. I want to introduce some new concepts. I'm sure it's very much related to what we've been talking to, but I hear other explanations for these kind of things that happen through a lens, I guess, a model of modern monetary theory, and I guess the velocity of money, which I understand to be just the rate that people are transferring money through the economy. And so, yeah, I just want to try and understand how those models relate to what we've been talking about and how people think about it.
Yes, of course I can. A lot of my career has been focused on money demand, and money demand tells you about the velocity of money. We define money demand relative to GDP. So it's like the amount of money divided by the GDP, the income of the economy, the output of the economy. We look at money demand in that way, normalized by output. Now, if you invert that, if you put output divided by money, that's the definition of the velocity of money, is how many times the money circulates to give you that amount of GDP in the economy. So what does the velocity of money mean? What does money demand mean? Well, money demand essentially tells you how much money people are going to hold given whatever the cost of money is. So if you have a demand function, demand slopes down. That means the higher is the price, the less you're going to demand. So the higher is the price of Mustangs, the less Mustangs you're going to buy. The lower is the price of Teslas, the more Teslas you're going to buy in the market economy. And that's why demand slopes down. It's the same with money demand. But we look at it as the real money demand. We look at how much money can actually buy goods and services. So we look at real money demand as money deflated by the price level. And we look at how much real money is being demanded relative to the cost of money. What's the cost of money? Well, if you're holding money, you're not investing it. If you're investing it, you're earning the market rate of interest. So the cost of money is the opportunity cost of investing it. In other words, the price of money is the market rate of interest. The lower is the market rate of interest, the less costly it is to hold money. The higher is the market rate of interest, the more costly it is to hold money. When you hold less money, when the interest rate goes up, the velocity of money increases. It's like a hot potato. You don't want to hold it because it's more costly to hold it. So you get rid of it and it circulates more quickly. So that's how money demand is related to the interest rate and how the velocity of money is related to the interest rate. Velocity will go up when the interest rate goes up because you want to hold less money. Money demand goes down when the interest rate goes up. What modern monetary theory does essentially is throw away the idea of the quantity theory of money. The quantity theory of money is telling you not only about money demand and velocity, but one other important thing. It's telling you that if you increase the rate of growth of the money supply, the price level will rise in turn. You increase the rate of growth of the price level. So the quantity theory of money, the main thing that people take away from that is the higher is the money supply growth rate, the higher is the inflation rate. And what modern monetary theory does is throw away the connection between the money supply growth rate and the inflation rate. Now, the reason they have done that and the reason it arose after 2001 is related to these interest rates being forced down below the inflation rate while the money supply was dramatically increased. After 2001, when the interest rate was driven down, it was driven down by the Federal Reserve buying a lot of treasury debt and increasing the liquidity in the capital market, driving down the interest rate in the short term. And they did it for 3 years, so it was a persistent liquidity effect. Well, the liquidity effect finally gets overwhelmed when the inflation rate starts going up, which it did in 2003, 2004. The inflation rate began rising and kept rising because so much money was entering circulation. Well, then they tried to raise the interest rates back above the inflation rate very rapidly, and we had the financial collapse. And this is when the rise of modern monetary theory came about. The Fed decided to fix interest rates rather than buying treasury debt and driving down the interest rates that way. They came up with a new way to put interest rates at any level they wanted, disconnected from the money supply growth rate. How? For the first time in history, they paid interest on reserves. I mentioned that earlier on, that in 2008, for the first time, they started paying interest on reserves. Now, the funny thing about this is that that was allowed by another 2006 act that was called the Financial Services Deregulatory Reform Act of 2006. And the reason why they decided to allow interest to be paid on reserves is that smaller banks, like those covered by FDIC insurance, had to hold a small amount of reserves at the Federal Reserve relative to their deposits. Those reserve requirements were small, and they weren't enough to allow the Fed to bail out banks during a bank panic, but there were a small amount of reserves. And small banks had a bigger burden on them because the dollar amount of reserves became capped. So large banks were essentially paying 0% of their assets, having 0% of their assets held as reserves, and small banks were having a bigger percent of their assets being held as reserves. So the idea that Senator Crapo had was to allow the reserves being held at the Fed, required under law, to earn interest. That interest would be paid only on the required reserves. So required reserves in 1975 of the whole commercial bank deposits were 5%. That fell to 1% by 2008 when the financial crisis hit because of the growth of these non-bank banks that weren't holding any reserves. So only 1% of reserves of the deposits in the commercial bank system were required to be held at the Fed. And the idea was to pay interest on those reserves so that the small banks were not penalized to the benefit of the large banks and could better compete with the large banks. That was the idea of the 2006 Act. Pay interest only on required reserves, effective in 2011. Then the bank crisis hit. In 2008, around September, the Federal Reserve System's reserves went into negative amounts. So they actually had a negative amount of reserves. So what did the Federal Reserve do? They had put into the Emergency Stabilization Act of 2008 the provision that would allow them to pay interest on reserves immediately in 2008. Now, there's one small point in the 2006 Act that I've studied. Even though it was designed to pay interest only on required reserves, if you read the Act, it allows the Federal Reserve to pay interest on reserves. All the legislative history is clear is that this was for required reserves only. All the economic literature was always around that the required reserves were like a tax, so we should pay interest on these reserves so that the banks don't suffer this tax. So it was always only paying interest on required reserves that was ever under consideration. But what the Federal Reserve did is they looked at the legal language of the Act, which didn't say interest on required reserves. It said interest on reserves. And they skirted the intent of Congress and paid interest on any amount of reserves. They were embarrassed. They got into a negative amount of reserves and they had to borrow from other central banks through temporary liquidity swaps to get the reserves in positive territory. And then they started paying interest on reserves. But when they started paying interest on reserves, they started accumulating all these reserves. So that's how interest on reserves happened. And that created the sterilization of the money supply and disconnected the interest rate policy from the money supply increase policy that allowed modern monetary theory to come into existence. Why? The money supply dramatically increased after 2008 and up through 2014, but the inflation rate didn't go up. The quantity theory says if the money supply goes up, the inflation rate goes up. But why didn't it happen? It didn't happen because the money supply that was increased, one for one, went into excess reserves held at the Fed. So all of the initial increases, really up until 2014, all of that money supply increase was kept at the Fed. It did not enter circulation. It was held as excess reserves upon which interest was being earned by the banks. That caused a disconnect. Why? The money supply increased, but the money supply in circulation is the only thing that matters. It's only how much money enters circulation that causes the inflation rate. So this disconnect allowed the modern monetary theory to claim that the money supply increase is unrelated to the inflation rate. So we don't have to worry about how much money we print. We can have any amount of deficit spending, any amount of Federal Reserve buying of Treasury debt and printing money. We don't have to worry about how much money the Federal Reserve prints. We can just bail out the banks. We can do whatever we want. It won't cause inflation. Well, guess what happened? After 2014, when the interest rates started to go up, the reserves started to get limped out, these excess reserves. They started to fall. They went from 2.7 trillion down to 1.3 trillion. They were falling right up until just before COVID hit. So we were hoping they would fall towards zero. People in the monetary economics profession were hoping we would eliminate all these excess reserves and that we could normalize interest rates once again. And the Trump administration had done that. They had driven the market interest rate above the inflation rate for 11 months in 2018 and 2019, finally a normal interest rate. But then as the presidential election came up, President Trump started demanding lower interest rates. He said, like President Obama had, and the Federal Reserve started lowering the interest rate below the inflation rate. Then COVID hit, and boom, the interest rate went way below the inflation rate. Well, so what happened then? Interest rates were very low. The reserves being held at the Fed were very high. Once the spending of COVID was financed by the Federal Reserve buying Treasury debt, the reserves held at the Fed went up to 4 trillion from 1.3. The Federal Reserve eliminated reserve requirements, which they had had in existence since the beginning of the Federal Reserve in 1914. They eliminated them in 2020 because there were trillions of excess reserves, and it was meaningless to have reserve requirements anymore. So they stopped calling it the interest rate on excess reserves and called it the interest on reserve balances, because there no longer were any required reserves. But the other thing that happened is there were so much excess reserves and so much money being printed that it was lent out. Even though there's still 3 trillion held in reserves, there was so much money printed. In other words, if you look at the amount of Treasury debt that the Federal Reserve bought, it was way more than the amount of excess reserves. So the money entered circulation and the inflation rate went up. So if you look at the amount of money that entered circulation, not the amount of money supply that was created by the Fed, it follows the quantity theory throughout. From 2008 through 2023, the rate of growth of the money in circulation and the inflation rate are very, very highly correlated and closely aligned, and verify the existence and working of the quantity theory of money, not the modern monetary theory, which says that it doesn't matter how much money supply you print.
That makes a lot of sense to me. I thought the modern monetary thing was just saying that the government has this ability, and I thought it was kind of obvious that they do, but you're saying that it's more or less consequence free, which doesn't make any sense.
In terms of inflation, that's right.
Yeah, in terms of inflation, right. I want to talk a little bit about, I think this hopefully will relate to what we've been talking about with basically the social engineering of government and how the government taxes and spends certain things to get economic activity in certain sectors of the economy, and how that works and how that relates to, I suppose, the velocity of money, the turnover in these different sectors. So like maybe an easy example is they want to limit some activities like tobacco use, risky behaviors, unhealthy things, so they'll tax that, and that puts a pressure on that behavior. And then they want to encourage other behaviors like education, so they'll invest in education, they'll give low interest loans to students, and that encourages economic activity in those sectors. Can you explain, I guess, the role of money in terms of social engineering, if that makes sense?
Yes, Matt, you have phrased very well the whole role of the government, broadly speaking. And to me, it also fits within the social insurance concept, because what happens if people smoke? What happens if people drink alcohol too much? They get sicknesses. So the bad state of affairs occurs where they get cirrhosis, where they die, where the pressure, the payments by the health system goes up. So it becomes a social problem if there's too much alcoholism or too much smoking. And so to try to social engineer, as you say, or provide a better mechanism whereby we have an efficient social insurance, we put taxes on those industries that are bad, and then we limit the government exposure in the healthcare system because they have to make healthcare payments as part of the social insurance system. So those taxes on those bad health items are part of the health insurance that the government provides in an optimal way. And gambling is a way, taxing that, making it legal, making drugs legal, and then taxing that is also part of that. It's good to legalize marijuana and then tax it, because then you get the government revenue so that you can treat the mental health issues that arise from too much marijuana use, too much drug use, and so forth. So you can apply that to all government policy, this type of social engineering. And like you say, the market for human capital is not a well-functioning market because people are not able to view the future stream of somebody's ability when they get an education. If they invest in education, it's unclear. It's not like in a firm where you can accurately try to gauge the future stream of dividends and capital gains that will come from owning that firm's stock. In the human capital market, it's a much more imperfect market. And so there becomes a role of the government to help fill that market imperfection by providing subsidies, a lower rate of loan interest rate on student loans. Forgiveness can be part of that. But to generally subsidize the education sector and increase the human capital of people so that you increase the welfare, the health, the happiness, the growth of the economy. And that is right. Now, where does money come in? Money is simply part of the government's means of operating. So, as you said, you need a legal tender. People need to use a money in transactions that they trust. So then you get the very first role of the government in having money. They need to supply a legal tender. Now think of this, Matt. If the growth of the economy is 3%, you could increase the money supply at 3% a year because the money demand would go up by 3% a year in line with the growth in the economy and have zero inflation. Because if the growth in the money demand equals the growth in the money supply, exactly, you'll have zero change in price level. Now, what's the advantage to the government? So take Florence and Venice during the 1300s. They supplied a stable coin that was used throughout their regions for 300 years. And what was the benefit of supplying that means of exchange is that when the demand for the coin went up with the growth of the economy, they could decrease the value of the money slightly over time in each coin because the value of that gold was going up with the growth in the economy. So to keep the inflation rate stable, they would decrease the value of the gold, say by 3% a year. What would they do with that gold? they could mint new coins. The original money that you raised by having a stable currency was called seigniorage. Nowadays, we call that the inflation tax revenue. So the role of money comes into the role of the government in that it is one means of financing government expenditure. Government expenditure has to be financed by tax revenue of all forms eventually. So if you borrow, you have to pay off the government debt. And when you pay that off, that's financed by tax revenue. So even if you borrow, everything has to be paid off by tax revenue eventually. The inflation tax revenue is typically a small part of that revenue that the government earns. Now, if you're in the Soviet Union and then it breaks down in 1991 and all of these countries suddenly become independent, just like the Continental Congress, and they have no source of raising taxes because they were under a communist regime for 50 years, and suddenly they're free and they have to make government expenditure. Well, what happened in Eastern Europe is many of these countries simply printed money and went into hyperinflation because they had no means to finance. So then money was used to finance all government expenditure. You had this high inflation tax, and that's not normal. Then the currency breaks down, the government can break down. So you don't want hyperinflation, and you don't really want high inflation. Nobody liked the high inflation of the Vietnam War in the 70s and the 80s. Nobody likes it today. So the role of the government is to provide this expenditure, which may be part of a social insurance system, as I view it. One means of financing it is printing money, but you don't want to rely on that too much. So when you do rely on it more, the inflation rate goes up, the value of money goes down because it can buy less goods and services each dollar when there's higher inflation. And that's what the government has to do. I'll add one thing. For the United States, it's very interesting. The Constitution requires all tax to be legislated in Congress and to originate in the House of Representatives, except for one, the inflation tax. The inflation tax has no specific legislation in the Constitution. It only allows the United States to have money, to create money, legal tender. Now, what people do not know is that there is a 1946 Full Employment Act, which regulates the Federal Reserve, and it tells them to balance the inflation rate against the employment rate. However, there was an amendment to that in 1978 during the Carter administration. Jimmy Carter was elected during a high inflation of the 1970s, and he appointed a man named Miller to be chairman of the Federal Reserve with the idea that they would lower the inflation rate. And during this time, going through Congress was a bill that became enacted in 1978 called the Full Employment and Balanced Growth Act of 1978 that stipulated an inflation rate target that could only be changed by Congress and the United States. And that was enacted into US law. It was put into the House, put into the Senate, reconciliation bill signed by the president. And the Federal Reserve is not allowed to change the rates stipulated in the 1978 Act. So actually, even though the money supply growth rate is unregulated by Congress, and the inflation tax, in a sense, can be whatever the Federal Reserve decides it to be, there is a little known act. It's disregarded today. It's by the Federal Reserve that stipulated an inflation rate target of 3% to be enacted by 1983 and 0% from 1988 onwards. It also included a 4% unemployment rate target. So there really was a law in place as to how much money the Federal Reserve could print. which was target 0%. Now, Paul Volcker is credited. It's called the Volcker deflation of the early 1980s. I'm sure you've heard of him, because what Jimmy Carter did is he let Miller be head of the Fed for 11 months and fired him, and because the inflation rate continued to rise, hired Paul Volcker in I think he started in 78 or 79. I can't forget exactly when he started. Hired Paul Volcker to enact the 3% inflation rate target by 1983 that was stipulated by Jimmy Carter. And what did Paul Volcker do? Exactly that. He dramatically lowered the rate of growth of the money supply from 1981 to 1983. Interest rates went up because liquidity in the capital markets went down, making the interest rate go higher. So it went very high, way above the inflation rate. We had a higher than normal real interest rate of like 4% on short-term treasury debt. It should have been only 2%. But because it was such a big, sudden rate of decrease in the money supply growth rate, to go from a 10 to 12% inflation rate down to 3% in 3 years, the real interest rates were very high, and that caused a recession in 1984, a severe recession. But guess what? The inflation rate on an annual basis in 1983 was exactly 3%. So Paul Volcker carried it out. He died just a few years ago, and he put out a book which went over his career, and he talked about this inflation law and the 2% inflation target, which is illegal under statutory US law. And he said, well, nothing in my textbook ever said anything about a 2% inflation target. But he also said, regarding the 1988 target of 0%, he said President Reagan wouldn't let him bring it down to 0 because he didn't want to risk another recession. But the point is, from 1983 onwards, the US was on an inflation targeting regime, and they successfully targeted inflation at a low rate, close to 3% or lower, from 1983 all the way up until 2021. And that inflation targeting regime spread globally. All central banks in the world target inflation at a low rate. Of course, they've all violated that after the COVID crisis, where the money supply growth rate went up so much.
Okay, that's a lot for me to chew on, but what I gather is just that the politicians have different levers to pull on to change the way the money supply balances in the economy, and there's more or less reasons for doing it. They have reasons for their decisions at the very least that are, built on some models that.
Let me just say, to finish out the point, which is that during crises, governments don't suddenly raise corporate and personal income taxes. So what do they raise? The inflation tax.
The supply.
They print money to cover the deficit. So they resort to the inflation tax during crisis times. There's actually been a lot of economic research on this, and a recent article, really interesting, by Eric Leeper and co-author, showed that when you have a really high amount of debt to GDP in the economy, and then you have even more debt, that gets financed mainly by the central bank buying that treasury debt. When you're already at a crisis level and the government debt goes up even more, the Fed buys all that debt, and that's where you get the inflation tax financing. So normally you want to finance it with stable taxes. You want stable tax rates. That's what the economy counts on, and it prospers with stable, low tax rates, as low as possible, that can finance the optimal social insurance system that the government can possibly provide, given its constitution, whatever country it happens to be. But during crises, in the United States, there is no limit, even though we do have in law the 0% inflation tax target. The Federal Reserve ignores that, and it prints money, as it's always. Central banks have done that during wars and bank crises, always in history.
Because they need the money, right? And that's the way to get it, is just make it.
That's when money supply becomes tax revenue. You
Okay.
normally want just a stable money supply and a small amount of inflation tax revenue. But then what happens is you rely on a big amount of inflation tax revenue during crisis times, and you print money to get that.
Okay, great. I don't have any other questions. I think we got to a lot of things and some good understanding of some of the crises that we're going through, and you gave a good historical perspective. But I think it's you kind of need those natural experiments to explain some of these concepts, I think.
I agree. I think we've covered a lot. It's been a great interview that you've done, and I really appreciate your time. I'm glad that you were able to allow me to expand on the historical experience, because it really is the only way to understand the current situation. And it's a lot of history to really try to understand and apply to the current situation. And it's not easy, and it's very complicated where we are now. But the historical experience, it really is the only way to know why we are where we are and how we should go forward.
Especially with economics, where it's really hard to like do experiments. So I'm an engineer, my wife is a physicist, and we create models and do experiments, but like economics, you create models, and where do you find the experiments to do them? You have to find them in history.
Exactly.
So okay, great. Thank you so much for talking to me. This was great.
Thank you, Matt, for having me on your podcast. I really appreciate it.